In this video, I will show you the top 3 methods used to determine targets on trades. Now, these methods are tried and tested over years. There's nothing secret about them. You can repeat them, you can do them yourself. In fact, I've simplified them even more than they could be. You could get very technical with them, and I think that's what a lot of people try to do, and then it gets confusing. So let's keep it really simple in this video. Now, you may have your own methods and been taught other methods. If you want to share those with us, by all means pop them in the comment section below. But I'll give you the reasoning why I've chosen each of the methods I've got here, and the method of achieving the targets, why they're actually there. So let's get on and look at what they are, and we'll start off looking at them, and we'll look at a chart on each occasion. So the first one here, previous highs or lows, great targets. Price tends to get drawn back to a previous high or a previous low. Sometimes it happens faster than others. Sometimes, if it's in a lovely trend, it will break through the highs and lows. But the key thing is to have a target. A lot of traders will trade without targets and then get a bit confused, and when the market starts retracing on them, they start selling the market if they're long, or vice versa. They close out their positions because they panic, because the plan is not there. So it's important that you have the plan from the offset and have actually got some determined targets. Now, when you trade and use a target, it should be pretty much a fixed target, because if you're using something that's moving, you get into the world of diminishing returns. So let's work on these 3 targets. Each of them has a fixed outcome. So firstly, I said double tops, double bottoms. So look, I can show you right the way back here. I mean, this has come through, done each of the bottoms here, and it is simply the previous bottom. So whatever, if you've played a retrace or whatever you've done, I'm not looking here how to get into trades. I'm just suggesting where the getting out might come. When it starts breaking down and you start seeing lower highs, it might be that you look for a bottom further away to be targeting, and it give you more space. So that's an important thing to take into account in terms of what's the price action actually doing, and can I move the target, or set the target as low as down here somewhere. It could be, if you pull it back a little bit further, you could see other areas. However, when you do this is quite a nice point to be looking at, because, well, actually that's a fair old target down here. You're looking at what's been happening. Could this continue to the upside? Who knows at the time, and it would be a pretty good target. And for a stage at least, you would have thought this was going to go and continue to the upside, with almost putting a higher low in, not quite making it. Okay, so there's the lows, and again you've got a low across here. Now, this low didn't go as low as this low here, but here's the little caveat within it all. When you're looking, the traders were trading slightly different ways when it comes to around highs and lows, and some will get out quite a bit earlier. Now, there's almost like a phasing out sort of zone, depending on what's happening. If there was a lot of sell orders sitting below this low here, the temptation would be to hold into it longer. If you could see what the orders were doing below there, it would be best to hold in. If you can't, and you can't see them, well, then it's the unknown, and as soon as you get into the unknown, there's uncertainty creeps into your trading. So let's just stick with what we do know. What we know at this point here is last time it closed above, on each occasion it never closed below this 14955 area. So that in itself becomes a target if you're approaching it once more. So that in itself becomes the target. Then sure, it increases your probability. Remember, at any low or any top, you've got a number of traders doing different things. On a low, you've got people buying at the double bottoms. They probably ignored all of this, and there was a head and shoulders and all sorts going on there, but they may have ignored that and be buying into these double bottoms. They're keen to buy. You've got the sellers obviously sitting on and selling, hoping for the breakdown. then you've got the people taking the profit. So you've got two lots of buyers and one lot of sellers effectively, and it comes down to supply and demand. Now I've simplified it there, but basically it is a supply and demand situation. Prior highs and lows are a key point, a pivotal area in a market regarding supplies and lows. And when I just put my cursor where it is now, if you look across the chart to the left, you'll see other areas around here. It's pivotal. So those highs and lows, very important. And of course, as I drag this across here, go up the time frames as well. Look at this here in terms of this high. It looks like it's come short of it. Go up the time frames to check out whether it's approached. There you go, there's the October. Now look at, if you put it to the body, which we've just done on the flip side, on the long side, on this short side, if you were in a long position or rather here, your target would be the bodies. That is never managed to close above that point there. That is the weak spot on the market. So the weak spot becomes the target, the exit, not the absolute high. And don't forget, or rephrase that, remember, add your spread onto things, because you won't get out absolutely on a high, on a low, if that's as far as it goes. You've got to allow your spread and maybe a pip a little bit on top of that. So there we go, there's highs and lows. Basic, simple, very effective. Number two, I wouldn't be the pivot trader unless I talked about pivots, and I've got to talk about pivots because they fall into play so well. To explain, I'll bring the chart back in and I'll put some pivots on it. What are we on, a weekly pivot? That's good. We'll have a yearly view probably. It's just put the pivots on. Yep, we've got yearly pivots here. They're fine. I've never specifically aimed for them too much, but they're fine. And in fact, this year it's been going absolutely super. But in fact, let's just move this across a little bit and down, just edge this down. So the process and the understanding here, when you've got into a situation and you've sort of got double tops and then it's triple tops, well, the next opportunity is a break of the tops, a breakout. I mean, even the third time it might go. It could go the second time. Might not just. That might be it. It might just go straight away if the market's strong enough. Often on a first wave in a structure, in the Elliott wave structure, the first wave, it won't mess around. It will just go. This is something more around the sort of top end of the market when it's just getting a bit tired, and then eventually it goes. But when you've got a market doing this, the double tops is limiting your trade when it gets to this point here. So you need other methods which will see you through the previous highs. Otherwise you're going to be stifled and leaving things behind. Maybe on a first move back towards a high, you trade for the high. Maybe you mix your methods up a little bit here and use pivots, or what I'm going to talk about in a moment, as an alternative. Now I'm just looking at a weekly chart, doesn't really matter, but the principles here is the same whichever time frame you work it on. You've got the pivot point itself, that's the PP, the black one here, that's the main pivot point. It has a high probability of being hit every day on a day one, every 4 hourly on the 4 hourlies, weeklies, weekly, and so on, and they have a high probability of being hit. Beyond that, you've got then the R1, the resistance one, which people just think of as a resistance, and support as a support, the S1 below. However, these resistance and support levels can become targets, and very good ones. The probability of any one of these being hit doesn't look so good on paper, but when you look at every month and go back and do some analysis here, the probability of one or the other being hit is around about 85%. That's actually higher than the probability of the main pivot being hit. So if you're trading in trend, then in this particular case, the trend being up, it's hit the pivot, then the target seems to be a logical point above there on the R1. So it becomes a target point. So there you are. No calculations to do. It's done for you on your software, your charting software. This is TradingView. I'll put a link to the bottom on the bottom of the video somewhere for you if you're interested in it. But this is TradingView, great bit of software. It's cheap as chips and works perfectly. So there we go. Simple as anything. The same principle goes on all the time frames. Let me just get rid of my drawing tool here. Let me just run through some different time frames here. Let's just bring it down to a daily. So this has got a weekly. Is it? No, it's got the monthly on this one. It's the 4 hourly has got the weekly, which fits quite nicely. He says normally. Anyway, there you are. There's the weeklies, and you'll see quite often there will be occasions when, of course, it doesn't come back. It's nothing in this market. It's a foolproof or absolutely foul proof. They will at times not work. Some things are in such decent trends, like on this occasion here. There's a high probability of the pivot here or here being hit, and on neither occasion did it get hit. The market was just the momentum behind the market was too strong. But did the R1s get hit? Yep, sure they did. So if you've got in on a retracement, it's running into the next month, you're still in the position. Look at where the R1 is, or next week I should say in this particular case, next period. Okay, and we can look at them down on the hourlies as well. So there's the hourlies, and again this market turned out this now this is an hourly but with a daily pivot on there, a weekly pivot, I beg your pardon, on it, and the weekly pivot got hit quite early this week on the R1 there, so it hit the pivot itself and hit the R1 quite quickly. So do you aim for the R2s and R3s? I don't generally. So is the answer there, because the probability is less. You can watch a video on 5 facts about trading pivots on my previous YouTube videos. Right, okay, finally, wave structure patterns. Again, very simple. You might have seen some of these being used and taught. It's amazing how often they actually work, but you've got to get your eye in and understand what you're doing. And there's little sort of, I say secrets, it's things that I would cover in our day trading room in terms of when I'm looking at trade them, and I'll give reasons to why something's going to be more likely to happen this time than next time, or etc. It's just getting used to it. However, they work a lot of the time. In fact, I'm honest, this would do. So what sort of patterns can we use? Well, flags are absolutely perfect. Wave structure, a market, well, you can see where the market's working. I don't need to give you any examples or whatever else more than what's on here. You've got the impulse, you've got a retracement, you've got some impulse, you've got a retracement, you've got an impulse. So here you've got 1, 2, 3, 4, 5 waves at the moment. Has it got more legs in it? Possibly. I would say once it's done 5 waves, there is a chance that it might retrace a bit more. However, the one thing about trying to say that and use Elliott waves for that purpose is they're so unreliable, so I'd never ever say that. However, I would look at the waves and measure the waves and apply the wave structure. You can already see what I've done here. Let me just turn my pen differently now and switch over here. Now the principle behind the waves is that you can, see if I can copy that, clone it, and whoops, pinch it there, put it on the bottom of the wave. So the bottom of the wave was down here. Let's get rid of my pivots for a minute, otherwise you'll think I'm only interested in pivots. There we go, so you can see the waves. You could see what happened with those pivots. They were perfect in terms of finding support. This is where you can combine things, but that's not the subject. The subject is targets. So let's keep on focus, Kim. So there's your initial wave. It's pulled back, it starts moving again. So the target is literally the length of the wave. I'm a little bit conservative. I'll take it from the bodies. I'd rather be under promising and over delivering than over promising and under delivering effectively on trades. Now this actual target here, even taking my method there, it would have seen another retrace coming through there. But you can see how straightforward just when you're looking for targets. Now of course you could have been looking at the prior highs here as well. So if you're getting into a target, it might have been a prior high. When you're looking at the trend that the market's in, when I pull it back, you can see the trend that it's in. You'll be able to say, well, actually, this could be going further. You might do. Retrospectively, it's always easier. But if you can't, well, then you just look at, well, maybe taking part off at the prior highs there, but there's other methods to add into it as well. So when you're starting shaping up, you can look across a number of methods. The last look, there's a channel running across here. If I clone that, pop that on the bottom there. In fact, I'm going to be a bit more aggressive. There you go. And there's the channel. Now the channel, again, you can measure the depth of the channel and apply it to the breakout. In fact, here's one I must have done earlier. Let's just take it. Yep, there's the depth of the channel, and we apply that to the breakout. There's the target. The target comes for the prior highs in this particular case. So, and it's had a reaction shortly afterwards. Look, as it happened, it broke through. The price came back. But that's just applying different patterns here. Really, one of them is an overextended flag, to be fair to it. But it's sitting there flag-ish. You're applying the waves anyway. It's actually got 1, 2, 3. It looks like we've got about 5 waves in the wave. Quite irregular, but then it's pushed up. It's seen that one off. So the flag element is worked off. The channel here, ascending. The market's ascending, descending channel off. It's gone and worked. And then you've got all these other little flags that are kicking around here. So even if you didn't catch the first one, there's plenty of others to be had. Let me just get rid of some of these out of the way again. And there's possibly another one in progress at the moment. But this is where personally I'd start thinking, well, actually, I'll leave this one a little bit more. Now this is a flag here, so it depends if you've got a trade. You may be buying on a retrace. Where do I target? Just here. It's not really worth it. What's the market doing? It's getting better. It's put a little higher low there. Maybe I'll take the flag and trade the flag and use that as the target. So that will be your target length. We can either clone it or just pinch it and move it up there, and then again it's been hit. And then you've got this one itself. There's another one sitting at the highs here, and again, now this is assuming you're using a method of retracements and trading in trend. But there you go. This one might have been short and might have come up short for this last flag, but it is, as I said, it's done multiple flags already and multiple movements. It could just be tiring somewhat, but something's going to work for some of the time. If this works and these targets come in 70% of the time, that's fine. Okay, that is pretty much it. However, I did put another thing in small writing here, because I know if I don't put it there, lots of people will say, hey, how about moving averages, Kim? Well, what I've shown you so far have fixed targets. Moving averages are fine, but they're a law of diminishing returns. And when you pop a moving average on, if I can put a moving average on here, and get rid of everything else, let me just get rid of these lines. Okay. Let's just go into a daily, so we just get a bit more of a target there. Okay. So as I say, they're diminishing returns. It depends. I'm just looking for a little pattern that we could have been an entry amongst all of this. Yeah, that'll do. Maybe it won't do. Just looking. Let's just come down the time frames back to an hourly. May have been a better example there of something where it's Yeah, I can see an example just here. Fine. Now, the price will inevitably, moving averages are great targets in terms of they will get hit, but it's diminishing returns. I was just looking for an example of something that was a bit more likely to happen, and the reason why they're not so good at the time, or they, as I said, it's the diminishing returns aspect of them. Let's just say I was trading this and I was looking for a lower high. I believe for whatever reason I wanted to go against a major trend, but let's just say I was feeling that way inclined and I was selling here. It didn't actually trigger until this point here, which would have made, if I was looking at the 34 for example, just not interesting at all. Maybe if I put a bigger moving average on there, it would have been, in fact, let's just change the moving average. Let's put this on 50 is a regular number that traders look for, so let's just run it onto a 50. So at that point, well, a 50, it's given me a target below here. Now it didn't get hit, but if it had, you can see what's happening, and this is the main point, is the diminishing returns. Effectively, if the market stalls and consolidates a little bit, your return is reducing all of the time. So what's set out with a decent risk reward, yes, you're hitting a target, but it's not the original target. Aside of it running against the trend, which a lot of traders unfortunately do, is they want to be trading divergences and whatnot just to come back to these moving averages. But the probability is a law of, as I say, diminishing returns. So the more you're trading back towards those, what sets off quite nicely initially, if you get a bit of a consolidation in the market, your returns reduced. Hence why I've left moving averages out. It's not the best of examples, but I think you can understand what I'm saying. It may have been that back here that you've seen there's a better one. There's a lower high that's come through. Target, when's it hit it? Right the way up here. So significant difference in what the actual result compared to the target. I will leave you there. I wish you a lot of good luck with regards to this. If you like the video, please give me a thumbs up, and also, more importantly, if you're not subscribing, subscribe to the videos. Take care. I'll catch you later.